Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host here. I'm raising my hand because I have a question throughout the whole thing, but Jeff is answering all the questions. Of course, we have O'Neill, portfolio manager, O'Neill Global Advisors portfolio manager, Arusha Pires, who joins us every week, and our special guest this week, returning to the show with a special mid-year edition, is Jeffrey Hirsch from the Stock Traders Almanac. So, Jeffrey, let's go ahead and get into the presidential cycle. So, a lot of times you're kind of breaking down a cycle that happens based on the election cycle, for the presidential. So of course you got year 1, 2, 3, 4. There's a 4-year cycle, and then of course, do you break it down from, okay, this is a incumbent cycle versus a first term, and so on. You've got data on pretty much everything, right?
We do, and sometimes you break it down too much and you end up with like 3 examples.
Right. Yes, a sample size of.
So you have to be careful with that. However, I learned from Larry Williams that sometimes an analog of one is just as valuable if it tracks well. So it doesn't always have to be a massive amount of data points to get a good average, because then you're just averaging things out. So it depends upon your usage, and I guess that's why we do what we do, so you can know what's relevant at what time. And right now, this chart that we're looking at, I mean, I created it, but it is one of my favorites. Is one of the keys to trend following, whether they be technical trends or seasonal trends or what have you. When the current market, the current trading is tracking the trend closely, as you can see in this image, they are, and it continues to do so. It just keeps reinforcing the continuation of the cycle. It's like inertia, so to speak, until it gets broken. So what we have here is the 4-year presidential election stock market cycle going back to 1949, and we go there. I'm sure you guys know, but the world changed after World War II, and 49 is the first full 4-year cycle since then. And then 21 through 23 here, which amazingly is moving quite closely to the pattern. You can see Nasdaq in this blue line, was below average in the big sell-off we had last year, but the trend is true. And what this tells us right now is I've got a few sideways arrows here that, we discussed a little bit of the sweet spot in the first segment and earlier this year, that despite that sort of December, late year sell-off in November, December sell-off in Nasdaq, and there was a little bit of a pullback down in the S&P, as you can see there towards the end of that chart. This sweet spot, the 3 quarters, midterm fourth quarter to pre-election year second quarter, really delivered, and above average gains. We discussed, Nasdaq up 37%, the NDX, the Q's up 45 or 6. The Dow and the S&P right on a point about 20%. I think the Dow's a little bit lagging that average, as you can see the red line sort of below, but the Dow caught up, the last couple of months a bit, as there was some rotation into industrials and such. But what this tells us is that we've hit that mid-July peak of the pre-election year, which the next 2 charts you'll see even more clearly, and that shows the little August sell-off that we're beginning to accompany. I guess it's most pronounced in the dotted blue line of Nasdaq up there. A little bit of a rally from the end of August, like we discussed last segment, into mid-December. Then it sells off again. End of third quarter, Arusha, you'll attest, is usually quite volatile and to the downside. For fund managers, all you guys that run institutional money are what creates this pattern. This is a institutional money manager driven market, and these patterns are based on that. Learned that from Yale years ago. Some of it has to do with just window dressing and portfolio adjustments, getting ahead of Q4. Some of it has to do with the October 31st deadline for the IRS from the 40 Act requirements for the accounting adjustments or reconciliation that has to happen every year. Some of it's a little self-fulfilling, like the October phobia, but you see that transpire at Q3, end of Q3, and that's why September is now the worst month of the year, and it has been for a while. And then the good news is the fourth quarter, the rally resumes, as it is likely to, as it has historically. I can see us hitting new highs, like all-time highs around year end. There's another thing that we have in the Almanac. It's actually in the current edition, the 50% move from the midterm low to the pre-election year high. And when I present that, I probably did it with you guys before. The sort of, it's about 48% on Dow and about 68 Nasdaq. That midterm low, so like October, December, whatever that low is, to the pre-election year high could be on average, 60-70% for Nasdaq. I mean, it's got quite a trajectory heading that direction already. But the other thing that I always found amazing is that most of those pre-election year highs, or the biggest cluster, transpires in December, and a lot of them on that last trading day of the year. So be prepared for this sideways chop and flop, pullback correction, nothing sinister, probably 5 to 10%, probably get a couple of touches of that, but and then when everyone starts to throw in the towel, it's not just a correction, and the buy the tip crowd quiets down, we'll probably be ready to rally Q4, maybe another October turn. Wouldn't surprise me.
Well, let's take a look, kind of a zoom in of this particular third year in our cycle. So you've got the S&P 500 pre-election year chart that you gave us, and this is the S&P 500 that we can start with. Again, it kind of you've already talked about it, but you can just anything else to kind of add with this chart. And just as a reminder for folks, if you're listening to this on the audio, these charts, you can find them on investors.com/podcast to watch the video version. I think, Jeff, you said that you tweeted out a number of these charts as well. You can find Jeff Hirsch
for sure
at Almanac Trader on Twitter or X or whatever you'd like to call it now. But yeah, go ahead.
Yeah, we'll have to figure out what to call it.
Yeah, right. I'll still go with Twitter for now. While it still uses twitter.com, I'll still refer to it that way. But
for the record, I'm okay with the X. I don't have a problem.
I don't care either.
I'm just gonna go.
It works. Everyone's talking on there. Like, I know the little bird.
Yeah, I missed the little bird though.
I mean, either way.
Yeah.
As long as it works.
Anyway, what are we looking at here?
The thing other than the midterm, other than the pre-election year, I have the word midterm here. I'll explain that in a second. But is the red line is my aggregate cycle, which it combines all years since 49, all pre-election years since 49, and then all third years of the decade, the decennial cycle. So that's what that is. A lot flatter because of the different factors that are averaged in there. The green line is this pre-election year after a midterm bear market. Not a lot of people were willing to, say it out loud that we had a midterm bear market, but we did. And you can see that the pre-election year is much stronger after midterm bear. And then the first term in the blue line kind of tracks that midterm bear year. That's, a first-term president, which the whole driving force of the 4-year cycle is how the government manipulates the economy to stay in power. And that's a page in the upcoming book which shows all these things that presidents and incumbent administrations or incumbent parties do to juice the economy and make the populace happy. And there's all sorts of things that been done with money coming out there. I think this year, which I wrote about in the book, the 24 book coming out, the negotiation around the debt ceiling,
right.
which I had spoken about, and we weren't expecting to be as bad because we'd already seen the movie before. And Biden, the consummate politician, whatever you think his mental capacity is or whatever your political, leanings are, the guy's been around the block, been around the Pennsylvania Avenue for several decades. Not quite as long as the Almanac, but pretty long.
But up there.
But he knows his way around, and they built enough of a team around him that they, and he worked with the other side, with McCarthy, and he basically, put the kibosh on any more debt ceiling issues, and also didn't turn off the spigot on all the spending. So that was kind of a typical pre-election, priming the pump, how the government manipulates the economy type of move. And that's why we have this 4-year cycle, because there's no other country on the planet that has regular elections like we do. There's votes of no confidence. Look at Israel, the UK. I mean, I don't know what they call an election over there in China, but it's not really. It's a cycle I've been thinking about looking at because of when they have the Communist Party thing, but that's another story. So here we have back to 2023 in the purple line, above the averages, but the trend is there. The trend is there. There's your March sell-off that we spoke about before. And here we are in this sort of mid-July peak. It rolled a little bit longer. You're going to see it more pronounced on the Nasdaq one there, but basically sideways, maybe a little bit of rally here off this low. It's not guaranteed. Pre-election year shows it a bit more, but we get the CPI tick up. Here's some other disappointments. The Fed starts, hawkish rhetoric again because of whatever happens. We may not get that rally, but again, the arrow says it all. Likely to chop along sideways until we get through October.
And if we look at the Nasdaq, kind of, the data for the Nasdaq, one thing I'm just wondering, because the Nasdaq got so far ahead of the typical. Again, I think, as you mentioned, the Nasdaq was up like 45% year to date at its peak. Is there ever anything where, if it gets a little bit overheated, the trend gets a little bit more, I guess, beyond its norm? That
I'm not sure. Yeah, I'm not sure it correlates. Just because you have more amplitude on the upside, that you're going to get more on the downside. Again,
okay.
There's a momentum thing, and gains tend to beget gains. So I wouldn't necessarily suspect just because it went up so much more than average that it's going to come down so much more than average. That's not causal. But because it's tracking this, and trend is more important than level in all these types of things here. And what we're seeing is really quite a typical. I'm actually drawing a line here with my mouse, but you can't see mine. The July peak, right on the edge of this yellow frame that I put there, we sort of hit that right up here in the purple line as well. You see the red arrow I drew there. Yeah, we bounced again at the end of the month, but we're heading into this sideways situation. I have to check myself that it's going to continue tracking so closely. I mean, thankfully it's been much bigger, so it's not exact.
Right. Well, and if you're not going to be exact, it's always great to have it be more gains. No one's going to get mad at you for that. Oh, you were wrong.
Right.
But it also speaks to your earlier point that your concern was that you weren't bullish enough.
Yes.
When the year started. So
no, we did have our MACD sell signal for the best 8 months of Nasdaq towards the end of June, right here in that late sell-off. So we don't claim to pick tops and bottoms, but we try to get the big chunk of the trend. So
yeah.
And Jeff, I do remember back, it was like during May, where it was in one of your updates where you talked about the sell in May go away, and you mentioned in the Nasdaq it's actually till the end of June.
Yeah.
So I clearly remember that in May. I was like, oh, that's really interesting. Like S&P was end of May, but Nasdaq actually goes through the end of June.
And Nasdaq and all the techs are starting to influence the rest of the market a little bit. You see S&P pushing a little bit further and everything else too. So it may be shifting.